Welcome to another episode of Game of Investing podcast. Today we are going to delve into a great business that is from India in a segment which is very difficult to operate in. I'm talking about the retail business. Retail businesses are, we know, wafer thin margins, very difficult to operate at large scale, and it is a complex business. We know that in the Western world, in US and UK, there are many retail chains, whether it is groceries, whether it is clothes, retail clothes, fashion brands, they have all winded down in the last 1 decade, especially after the e-commerce penetration. But we know that, the JCPenney's and Macy's of the world who have filed for Chapter 11 bankruptcies in US, and there are many such cases. So it's a very difficult business to operate in, especially when it comes to the fashion retailing. But there is one such business in India which has exceedingly done well in the last 5 years, typically last 5 years. For whatever reasons we are going to delve into, there are many strategies they have deployed right. They have many operational things they have executed well, and a great management at helm. I'm talking about Trent Limited. Trent is a company that is into fashion retailing, which is primarily a Tata Group company. It's a family-owned business. Tata Group is a family-owned business in India, and they have you name it, across industries. They have all the companies out there, and almost all large companies out there in India is family-owned, and it's conglomerates under the Tata brand, Tata ownership. Now, Trent is a company that is very interesting because I wanted to delve deep into it because they have been doing so well from a revenue growth standpoint and operational metrics standpoint and the return ratio standpoint. In all aspects, they have been firing in all cylinders. So that caught my attention. I'm a shareholder, by the way, that's a disclosure, since last couple of years, and I've benefited immensely from this company. So whatever I'm talking about, please take it with a pinch of salt. There might be Western interest. So Trent, let's get into that. So let's get into the history as usual. 1952, just a few years after India got its independence, India did not have any domestic brands or beauty brands that's India-based. So most of the brands, products that people were using were imported from foreign countries. And so the then Prime Minister, Mr. Nehru, wanted to have a domestic or India-based beauty and cosmetic products so that people don't go and import from outside countries, and he wanted to curb the currency outflow. And he had a discussion with J.R.D. Tata, then the conglomerate Tata Group's head, and he aspired to create a domestic India-based beauty and cosmetic brand, and then they created Lakme with a joint partnership with Tata, and they took a stake, and this Lakme was catering to the beauty and cosmetic demand in India for quite a long 4-decade period. Then in 1998, the Tata management decided to shelf this joint venture, and they just broke this partnership and sold the 50% stake to Hindustan Unilever (HUL) in 1998 for a proceeds of close to 200 crores. That's like approximately $50 million. Now, and they decided to set up a Trent-owned company. So Tata-owned company that is completely focused on physical retailing and fashion brands. So Trent was born. But now let me tell you, this $50 million might sound some princely amount there, but 1998, with India's per capita and the total GDP size, the largest company in India, I think it was Hindustan Unilever, was approximately $8 to $10 billion market capitalization. That's it. That's the largest company in India. The Reliance, which was second or third largest, was approximately $5-6 billion during that time. That was a total market capitalization. And from there, look at Reliance growth. Reliance itself has grown around 25-30 times. Today, it's around $240-250 billion. So it was a tremendous explosive growth for Reliance itself in the last 25 years. It has grown 30 times approximately. Now, coming back to Trent. So now Trent was intending to create their own brand. So the flagship West Side brand the shop was created, the retail store was established in 1998 in Bangalore, and they had a parallel opening in Hughes Road, Mumbai. So these were the first couple of stores, West Side stores. Now, look, Westside had a very clear intention of bringing a premium brand throughout. So they never intended to go into, growing explosively. They focused on margins. They focused on cost. It was a measured cautious growth factor. So between 2010 to 2021, you won't believe this, they just opened 100 stores in total, right? So it was a very tepid growth, but they focused on margins. They wanted to expand, they wanted to establish the brand, and they took their long-term path. Now, another interesting aspect about Trent as a company is during this journey, you can see on the screen. Now, Trent has two segments to it. They have their own brands and they have joint ventures and partnership. So what are the own brands? They have Westside, then there is ZUDIO, then there is Misbu, and then there is Utsa. So different categories, right? Westside is a premium fashion, ZUDIO is affordable fashion, then Misbu is affordable cosmetics, then there is Utsa, which is ethnic wear. Then they have joint ventures with Zara. Zara is the most famous global fashion brand out there, like the Zara and H&M's of the world. And then they had a joint partnership with Star Market, which is into hyper retailing, hypermarkets and grocery retailing. Then they had a joint venture with Massimo Dutti, which is more of a high-end premium fashion retailing. So this is the journey of Trent, and you can see on the graph, it was conceived 1998. Westside was born 2014, joint venture with Star, ZUDIO 2016, Utsa 2019, Misbu 2022, Samo 2023, and in between they had Zara and all of that. This is just Trent's journey. Trent owned brands, but they had some joint ventures too. So in all, if you notice, they have close to 214 Westside stores, 352 ZUDIO stores, all of those other stores are like in double digits. Star is the third largest, I think. They have around 63 hypermarkets. So as I said, you can see on the screen, Trent's revenue growth has been tepid, really tepid from 2010 to 2021 all the way. It's a decade lost opportunity. They had a revenue growth not even double. Their revenue in 2011 was roughly 2100 crore. In 2021, it was roughly on 2500 crore. So it's roughly there. They didn't have a major growth or even doubling in the last 10 years and till 2021. So what really changed? If you see in the graph from 2021 onwards, it has taken off and it is an explosive growth. So what really transpired? Answer is ZUDIO. ZUDIO is really the game changer for Trent. The affordable fashion category is a wide space in India, there was not many players out there. There are just a couple of them in India who were catering to the tier 2, tier 3, tier 4, tier 5 cities in India. And so there was a big gap. There were stores for tier 1, there were stores for tier 4 or tier 5, but there was a big gap between tier 2, 3, which is the prominent burgeoning middle class growth that is happening in India. So it was a large addressable market, untapped, which Trent saw an opportunity, and they decided to establish the fashion that is affordable fashion for the middle class out there. So ZUDIO was born. The first store was established in 2016 in Bangalore, in the same place where they opened the first Westside store, and the rest is history. So if you noticed, after 2021, ZUDIO is the real game changer for Trent. And we are going to delve into what are these 4-5 strategies that really worked for Trent and particularly ZUDIO per se, because ZUDIO has been the real growth driver for Trent. We need to understand what really led to establishing ZUDIO, because Westside, an average selling price in Westside brand was roughly 1500 rupees, which was a perfect for the premium tier 1 city population. But for a tier 2, tier 3, the aspiring people who were looking for fashion brands out there with good quality, they were not having a brand or a chain of retail stores. So ZUDIO was born, and if you notice in ZUDIO, the average selling price is roughly 500 rupees. We'll get into those details. Now let's get into one by one strategies that really work for ZUDIO. The first strategy is affordable fashion works. No matter which part of the world you are in, especially the emerging economies and developing economies, affordable fashion is a definitely must-have category. And before I delve more into details, there is a CEO who took over, Venkateshulu, who is a CEO of Trent today as well. He took over the CEO role in 2021 and has executed operationally and strategically really well under the Tata leadership. So let's get into the affordable fashion category. Why does that work whichever part of the world? So last week I did a podcast on, in the game of investing, we delved into Elf Beauty. If you have not checked that out, please check that out. Elf Beauty is I found a 90% correlation between Elf Beauty in US and the Trent stores in India. I mean, not only from a retailing standpoint, but I found, apples to apples from a return on invested capital, inventory turnover, the affordable category, the strategies that worked. A lot of things were in common. You will notice that when I delve more into detail. So let's understand, the USP of Trent was being affordable, but at the same time being trendy and give good quality to people. So how did they do that? It is difficult to have an average selling price of 500 rupees in ZUDIO stores and provide a good quality and being trendy, right? So the interesting factor is the Trent had a joint venture with Zara in I think somewhere in 2014-15 time frame, somewhere in those time frame, 2016, and that's exactly when ZUDIO also started. But ZUDIO wasn't so much into the explosive path in the first couple of years, but Trent was very quick to learn about the Zara's business model, because Zara and H&M in US and many other countries, many of these retailers have a very similar strategy. They are fast fashion, they are low cost, affordable category. They have premium too. I'm not saying they're just into affordable, but they have affordable. If you notice H&M, they have a $5 t-shirt all the way up to $50-$60 t-shirt. So there is a range, right? But it's all fast fashion. So fast fashion is a category that Trent learned from Zara, probably. I'm assuming there. But the USP was affordable, right? So you can get dresses, from 199, 299 rupees, 399 rupees, all the way up to everything is less than 999. So that is the upper limit. So it's pretty much targeting the Gen Z and the millennial population, especially the Gen Z and the millennial, because people under the age of, you can see in the graph, people under the age of 25 account for more than 40% of India's population. That is a huge young crowd out there. And the median age, or roughly the average age in India, is roughly 28. If you compare to a 36 in US or a 40 in China, it is a very young crowd, a vibrant crowd. And more than 4 in 10 people in India are under age of 40. And it is a burgeoning middle class out there. This particular group between the age of 20 to 35 is the major bulk lower and upper middle class between that entire category, and it was a huge untapped market out there which ZUDIO is catering to. Right now, if you notice, this particular price range, 99 to 999, is perfect for that category, and they are doing really well because there is huge demand, and the Gen Zs and the millennials. So this is one comparison with Elf, right? They were addressing the same population, the Gen Zs and millennials, because Elf was voted the number 1 in US as the best beauty product among these Gen Zs and millennials. So ZUDIO is addressing that community, and that is why they are seeing explosive growth across cities. Right now, take a comps between the prices here. ZUDIO price for a shirt, let's take a shirt. ZUDIO's price is roughly 299 rupees, an average shirt. West Side, it costs around 700 rupees, 699 rupees. Pantaloon, it might be 899 rupees. Reliance Trends, it is 900,000 rupees. So ZUDIO's is selling at roughly 1/3, 1/4 of the price of other retail chain out there. Now there could be couple of competitors which we'll get into, but the other interesting factor is ZUDIO's sales per square feet is roughly at 18,000 rupees, and whereas a West Side, it is it is just 12,000 rupees. Now the estimated operating margin of ZUDIO is just 4.7%, because it's not a high margin business. They are focused on rapid turnover of inventory. It is a high volume game. It is not a high margin business. So it's a low cost. It's a cost advantage, right? That's another comparison with Elf we'll get into. But they are having rapid churn. So it is 4.7% operating margin. It's a wafer thin margin, but their average sales per square foot is 18,000. That is higher than West Side. West Side is 15,000 rupees, right? So This shows that ZUDIO has a very rapid higher turnover of inventory, and it's a volume game. Second is fast fashion, which is a model that has worked beautifully over many decades in global brands like Zara, like H&M, like Uniqlo, like Shein. Especially with today's e-commerce, it has been fast capturing, right? So what is fast fashion? Fast fashion is a concept that is introduced probably by Zara in 1900s, and this is basically being trendy, having a rapid churn of product cycles, which means their inventory turnover is rapid. Within 2 weeks, the inventory gets turned over and they get new products on the shelf. Based on the fashion trends, being trendy, being to the date, they wanted to have the shelf filled with the products that are trendy. So there is a rapid turnover of inventory, and it's not that whole inventory gets turned over, but they addresses the trends based on the needs, right? Also to a great extent. So the rapid inventory turnover and bringing the product, the reduced product life cycle, which means that typically these guys have, the fast fashion guys have 2 weeks, 1 week to 2 weeks, anywhere between that range of product life cycle. So they identify the fashion trends. You can see it on the screen. They identify Zara's fashion, fast fashion model you can see on the screen, or for that matter, H&M, Uniqlo, Shein, all of them follow the similar strategy, Boohoo and all. So they identify the fashion trends, they provide the rapid design to the manufacturing team. The manufacturing is done very rapidly, quickly in 2 to 3 weeks. It's turned over to the warehouse as inventory and then reaches the stores. So it is a very quick span of rapid product life cycle, which is helping them to address being trendy and to the needs of the Gen Zs and millennials, right? So ZUDIO executed the same strategy. They just clone that model. So this is another thing I noticed in comparison with ELF, right? ZUDIO is very good in cloning what is, especially in the last 5-6 years. You see that they cloned the model that Zara has been following very well and over the last decades, and so they executed this fast fashion affordable category, fashion category, targeting the Gen Z and millennial crowd out there. So ZUDIO executed it even better, I would say, right? But you need to understand what do you mean by inventory turnover. It's an important concept to understand, especially in retailing. So it's nothing but how fast or how efficiently a company can turn over its inventory, or how fast the company can change. It's a financial metric that measures how fast a company can sell its inventory. So there is a formula you can see on the screen. It's a cost of goods sold divided over average inventory. So it's a churn rate of the inventory. For Zara, the average inventory turnover is roughly 12 times a year, whereas for ZUDIO it's 5 times a year. So there is still a catch-up that can be done by ZUDIO. But having said that, ZUDIO is executing really well. So how could ZUDIO do that rapid turnover, and how could they get into that fast fashion? What do they do well? First one is they ensure they have private labels. They are owning the design. They are manufacturing, maybe out through outsourced way, but they own the design. They give it to the manufacturing team. They get the products back into the warehouse, and they control the complete life cycle, including efficient supply chain management. They have very lean supply chain management, which is making them cater to the fast demand, right? So they can rapidly churn and provide timely delivery of products to their stores. So they have very lean supply chain. They have their own private labels, their own design, manufacturing process, the whole inventory life cycle. So they have a very good grip on the inventory management. So they see that when the products are in demand and they need to churn, they give the placement of orders very quickly, and they are in control of the whole life cycle. So they could establish this whole process really well. Now ZUDIO, as I said, the third strategy is something called as FOCO model, FOCO, that ZUDIO executed. There are two types of model. There is COCO, that is company owned, company operated. Then there is FOCO, that is franchisee owned, company operated. There are different types of operation models out there. So what ZUDIO followed is FOCO model, that is franchisee owned, company operated model. So what ZUDIO did is they wanted to expand rapidly. So they found a way to give it to the franchisees to expand rapidly in tier 2, tier 3, tier 4 cities. So they select so anybody could apply. You can go to their website, you can see on the screen. So they had this franchisee investment framework that they have put it on the website. So I can just go and apply if I want to set up a store, and if I qualify, then I get to open the store. But I had to put my capex, right? So I had to put the initial funding to start the store, and I have to put all the expenses out there, capital expenses, and the Trent would provide the products and the brand and the operational aspects, the support for all of that from an expense standpoint. So it is a model that has really helped Trent grow aggressively, right? So they were able to expand and grow, exponentially in all the cities because of this franchisee model. And in FOCO model, let me explain. There are two parties involved. There is a franchisor, that is Trent in this case, and a franchisee. So the franchisee puts in the capex, as I said, and franchisor provides the products and support and the expenses relating to operations to a great extent. So it was an asset-light model that helped Trent grow rapidly and at the same time not get impacted in the cash flows or the margins, right? So still they were able to capture almost 4.75% margins at a even rapidly growing at this fast clip, and not impacted at the cash flow levels because it was a very asset light model. So they were able to maintain high return on invested capital to a great extent as a company, right? So Trent as a company, I'm not just talking about ZUDIO, Trent as a company was able to maintain high return on invested capital. We'll get into that in a later slide. But this asset light model really helped ZUDIO grow too fast, at the same time not impacting margins or the returns, right? So what really happened here is, when they were able to expand so rapidly, the economies of scale took place. So the economies of scale is an important concept in retail that we need to understand, and this is the only thing that can help retail stores survive, whether it is physical, whether it is e-commerce. Economies of scale has to kick in, and companies need to have strategies to establish that unit economics benefits. Otherwise, they are going to get into bankruptcies, right? So otherwise, they will keep getting into the losses. They will be shelling out cash with no profit zone nearing. So economies of scale has to go hand in hand with the unit economics advantage that they can pass it back to the customer as well, right? So it's a flywheel. This was adapted by Amazon. This was adopted by Elf. There are many successful brands I can see that is adopting Mercado Libre in LATAM. So if you see in the screen, their store count has expanded from Q2 FY20. This is during COVID times. In the last 4 years, the store count CAGR is 64%. Now that is one hell of a growth you can imagine, right? And at the same time, they had. Now you might ask, what if ZUDIO is not able to keep up with this kind of growth? Because there is a limit, right? Maybe they can grow like this for next 2 years, 3 years, but the large base effect takes place. So can it sustain this kind of an earnings growth? Yes, because the answer is, you should look at the same store sales growth, which is an important metric when it comes to financial metric, when it comes to retail stores, right? Because the same store sales growth, SSSG, is to be assessed, because that is for almost 10% consistently for ZUDIO. So they have a 10% same store sales growth, which is pretty good. The fourth strategy that really worked for them is maintaining a low OPEX, low operational expenses or low operational cost, which is primarily involving lean supply chain management, as I said. And another interesting fact that I saw common with Elf and Zara is that Trent is following is, especially ZUDIO, they are not much into advertising or marketing. They don't have any marketing campaigns. You don't see TV commercials or sports or IPL commercials or all of that, because they are maintaining just the word of mouth through social media. So they are targeting the teens and the millennials, Gen Zs and the millennials out there, and they are the people who are hanging out most of their time in social media like Instagram and YouTube. So they targeted that. They created a profile, ZUDIO profile, My ZUDIO, in Instagram. I did a search. You can see it on the screen. They have these campaigns called Trend Branding and FOMO Friday, etc., etc. So they have multiple campaigns consistently constantly out there to engage the Gen Zs and millennials who are out there in Instagram. They have roughly 280k, 285k followers in Instagram, and they have a lot of campaigns. So there are maybe not followers, but there are people who are following in Instagram. So it was through word of mouth and the social media. They are in doing the advertising and the targeted campaign, as it called in today's world. They exactly do the targeted campaigns, and that is how they are able to successfully avoid or get rid of targeted commercials in TVs and all of that. So they don't spend much there. Now lean supply chain, as I said, and the outsourced manufacturing, maintaining the to the point inventory management, rapid search on, all of this is helping them maintain a very good OpEx model and at good margin levels, right? So the lean operational model is something that has really worked well for ZUDIO in terms of maintaining the margins. The fifth strategy, as I said, is really worked is locations. Now, location is a very important thing, as we hear location. That is for real estate or it is for retail, physical retail. So location is something that Trent got the strategy right, whether it is Westside or whether it is ZUDIO for that matter, or even Star. So ZUDIO is opening rapidly in Tier 2, Tier 3, Tier 4 cities, as we saw. And you can see it on the screen, they have recent stores, all like Surat, Guwahati, Mysore, Mira Road, Kochi, Coimbatore, all of these, Tirupur, all of these are like Tier 2, Tier 3, Tier 4 cities, which didn't have any branded, organized fashion retailing for that matter. There were a couple of them, like the Maxes of the world, but not in terms of quality levels, also not in terms of the branding level, right? So the private labels is where ZUDIO really captured the attention, and the locations were prominent in these Tier 2, 3, 4 cities. So all is good with respect to the revenue growth, sales growth, store count growth. All are rapidly growing, exponentially growing. What about the operational aspects? How good is their margin, Rao? Now that is something spectacular what Trent did from year 2021 till 2024. Year 2021, we'll take this, they had a margin of 4% operating margin, like any other retail store. Today they have a margin of 16%, and I'm sure down the line they're going to increase that margin too. Now, what is really leading to this kind of a margin improvement? Economies of scale, as I said, which is benefiting immensely. Second is the low cost operational efficiencies, which is kicking in with economies of scale. And they have very lean supply chain and lean manufacturing, lean marketing advertising model, which is helping them to curb cost. And this is, when they are expanding exponentially, they are increasing margin fourfold. So it's a brilliant strategy that Trend is executing out there. And obviously there are many other factors which you should look at private labels as one of the important metrics that is causing really the increase in margins for ZUDIO as well as for Star. Star, as I said, is a hyper retailing company that's out there. It's been a silent growth engine for Trend. If you notice, their owned brand, Tata owned brand that was selling product. That what I mean is like the products that are sold through the Star hypermarket. Tata owned only 24% in year, just in last year, Q1 FY23. So look at it. In last 1 year, the percentage of owned brands, Tata owned brands, has gone up from 24% to 66%. So that's a 3x increase in the percentage of owned brands, which means private labels, Tata owned brands through these hyper retailers like Star Market. Now, imagine what could happen to the margins, right? So this is one of the main leader for driving the margins higher, because when they are able to sell their private labels through Star, they are able to mark up, right, their own brand. So they have a premium and they get benefit, and they have less commissions to pay to the other brands out there, that is sold through the Star market. So there is no commission, there is no percentage cut that has to be given. So their own brands has reached 66%. So this has been a growth engine. Star has been a growth engine. Maybe I should do a different episode altogether for Star, but today's episode is about Trend and ZUDIO. So ZUDIO has been able to maintain margins, and Star Star has helped them, increase margins, help Trent increase margins. Westside is anyway a premium brand, so which has got good margins. So overall, their margins has been good. Now comes capital allocation. How good is capital allocation? I'm sure we know already that they're doing good. Now let's break it down mathematically or formula wise, right? So following the Michael Mauboussin's ROIC breakdown into differentiation times the invested capital turnover, right? So you can break it down as a product of these two. Differentiation is the competitive advantage that companies have, brands have, that is giving them very high margins, right? Operating margins and profit margins times the low cost advantage. So the sales over invested capital, which is nothing but the turnover of invested capital or the inventory capital turnover, is usually driven by the large volume businesses, volume oriented businesses like Trent, like the Elves of the world that I discussed last year. So one interesting important thing I want to bring out here is, believe it or not, when I did this calculation for Trent and Elf, it is the same two factors. So differentiation for Elf was roughly 11%, and 1.8 times was the invested capital turnover. It was 22-23%, 20% approximately for Elf, the return on invested capital. It's slightly higher for Trent because their turnover, invested capital turnover, is roughly 2.15, slightly above Elf, and their operating margin is 12%. So it is roughly 25.8% return on invested capital for Trent, right? So they have a slightly higher operating margin, they have slightly higher invested capital turnover because of the obvious reasons I told, because explosive growth and all of that. Now, the inventory turnover has a strong inventory management has really helped, Trent maintain, the good invested capital turnover, and margins are good, decent, and they are going to increase. So the invested capital, return on invested capital, is going to increase probably from 25, 26 all the way to 30 in the next 3 to 4 years, as they maybe slow down on the volume growth, maybe slow down on the store expansions, and put more efficiencies in the operating aspect. More goes into the bottom line. They could increase the margins. As I said, Star, they could increase their private labels. There are many ways they can increase their return on invested capital. Having said that, this is a very, very appealing number, a very appealing metric, whether it is inventory turnover, whether it is return on invested capital, whether it is operating margins, whether it is the levers they have in terms of expansions, the private labels they are starting, like the ethnic wear, the beauty products, which is a really untapped market in India. I think Nykaa is there, but you really lack private labeled beauty products. Probably Trend might come up with that. The ethnic brand is on huge demand due to the wedding, burgeoning middle class, and the wedding splurges that's happening in India. So there is a long runway. The optionality is so much for Trend to grow, unless otherwise they mess up in any of these execution strategies. I don't see a slowdown in the near term. Now, coming to the competitive landscape and the risk or threat, that's the only thing that can really derail Trend's growth, right? In terms of today, there is a large runway ahead, but what could really derail the growth? That could be e-commerce disruption. As we are seeing, there are many e-commerce players that is capturing the market share. You have the Amazons, Flipkarts already. You have the Sheins of the world, the Meeshos of the world, and tomorrow you could have a Pinduoduo coming and setting up a store in India. There could be many. So these are all Shein and Uniqlo are all same strategy that just has e-commerce but not physical store, not mainly physical. They have a hybrid model. Now, Trent do not have e-commerce strategy. ZUDIO at least do not have an e-commerce strategy. So there could be disruptions there. Now, there could be also disruptions in terms of physical stores that can come up. Today, Max is out there who is catering to the same community, same segment of middle class and burgeoning middle class. And then there is V-Mart, which is more into tier 4, 5 cities, not into tier 2, 3. They are been decent growing company, but they don't have a success rate as good as neither Max as good as ZUDIO has. So many strategies kicked off for ZUDIO really well in the last 3-4 years, and we have seen the shareholders benefit. The stock has gone up a lot, the revenue has grown a lot, the market capitalization is roughly 18 billion, 20 billion. Now, Now, the interesting aspect is 18 billion, 20 billion is not too big for a retail growing company like Trent. I have a holding in US, like the Celsius holding, who has a market with a company has a market capitalization of $18 billion, who was just catering to the US energy drink market, has a market capitalization of $18 billion, where Trent is at the same market capitalization with so many brands and a rapidly growing Indian economy and rapidly growing young population, with so many people coming into the job. It is a burgeoning the splurge is going to happen in the next 5 to 8 years as per capita income increases from 2.5K to 5-6K in the next 1 decade. So there is a lot of potential for this company. So I wanted to bring this up in today's deep dive. Trust this was helpful. Signing off, Sandeep Anand from Game of Investing podcast.